$10,000 a month, landing in your account whether you went to work that day or not. Sounds good, right? So what does it take to get there? How much do you really need sitting in a fund before it pays you that much? In this video, I'll break down exactly how much you need, the one decision that changes both, how much you need, and how fast you get there. And in the end, I'll show you how two roads lead to the same $10,000 a month in dividend income. One, the lump sum road, and second, if you haven't got money saved up, the daily road that gets you to the same place. Before any of that, there's a number you already know by heart. It's the one at the bottom of your own payslip. The typical full-time worker in this country takes home $1,258 a week. That's the median, straight from the Bureau of Labor Statistics. About 121 million people, and half of them earn less than that. Split that across a 40-hour week and you get $31.45 an hour. That's the number sitting underneath most Americans' lives. Now put our target in the same unit. $10,000 a month is $120,000 a year. A full working year is 2,080 hours. So divide it out, and $10,000 a month works out to $57.69 an hour, nearly double the median, and nobody's expecting you anywhere at 8 a.m. So here's the obvious question: could you just work your way there? Well, that depends on how big a pile you need to build, and that depends on the fund. So let me tell you what SCHD actually is, in case you're new here. It's an ETF, which just means one fund holding a whole basket of different stocks. So a single share buys you a slice of all of them at once. No picking, no research, no watching earnings calls on a Thursday night. This one's run by Charles Schwab, and it holds about 104 large American companies, all of them chosen for one reason. They've got a long history of handing cash back to the people who own them. That's the entire job. It isn't built to be exciting, it's built to pay you. And right now, it yields 3.19%. So to collect $120,000 a year from it, you divide $120,000 by 3.19%, and you land at $3,761,755. Take that and divide it by the median range, $3,761,755 divided by $31.45 an hour comes to just under 120,000 hours of work. A full 40-year career in roughly 83,000 hours. So that's about a career and a half, and that's your entire gross pay. Before rent, before groceries, before you raise anybody. You'd be working until you're around 120. That is, if you live till then. Not to mention you'd never spend a cent of it. Which settles something worth settling early. Nobody gets to $10,000 a month by working harder. That door isn't closed so much as it was never open. So what's the other door? You stop spending your hours on things and start spending them on machines. One share of SCHD costs $32.90. At the median wage, that's 63 minutes of work, a little over an hour, once. And that share pays about $1.05 a year. You do the hour one time, and it keeps paying. That $1.05 doesn't look like much, but it will in a minute. Here's the part that makes it work. SCHD has raised what it pays out for 14 years running. Run that forward 30 years at the rate it's grown over the past 10, and that same share is projected to pay just under $20 a year. 63 minutes of your life, spent once, handing back 37 minutes of wages every single year for as long as you own it. So the question stops being how much money do I need and turns into something you can actually count. How many of these do I need to own? 114,393 of them. So that's the target, a number you can actually count too, but you'd be handing years to one fund. So let's find out whether it's the right one. Two things are true about this fund's track record, and they completely disagree with each other. Over the past year, SCHD beat the S&P 500, 20.78% against 18.85%. Over the past 10 years, it lost to the S&P by more than 100 percentage points, 131.58% against 245.47%. Both of those numbers ignore dividends completely, which is a strange way to judge a fund whose entire job is paying them. SCHD hands back about 3.19% a year. The S&P hands back closer to 1.2%. So that 10-year chart is measuring the one thing this fund isn't built to win, and the thing it is built to win shows up in a couple of minutes. So who's actually paying it? Well, the 10 biggest holdings are ones you'd recognize walking through a parking lot: Home Depot, Merck, United Health, Amgen, Procter & Gamble, Abbott, Coca-Cola, Texas Instruments, PepsiCo, and Verizon. Those 10 on their own are 41.92% of the fund. So roughly 4 out of every $10 you put in lands on that short list. And the other 94, odd companies split whatever's left over, which sounds top-heavy, and it is. Although the average ETF actually packs a bit more into its top 10 than this one does. So it's crowded, but it's not unusually crowded. The biggest sector in this dividend fund is healthcare, at 20.67%. 4 of the top 10 holdings are drug and insurance companies, and together, they're 17.53% of the whole thing. About $1 in every $6. And utilities? 0.11%, basically nothing. Which is odd, because utilities are the first thing most people picture when they hear the word dividend. They're not banned, they just score badly on the two things this index cares most about: cash flow against debt, and how effectively a company turns money into profit. Utilities carry a lot of debt, so they rarely survive the ranking. REITs are a different story altogether. Those get thrown out by rule before the scoring even starts. The fund costs 0.06% a year to own. The median ETF charges 0.5%. Sounds like nothing. It's a rounding error on a coffee. Except Josh holds this till he retires, and that rounding error would cost him over $200K in portfolio value. Seeking alpha grades every ETF on the market, and SCHD's card is worth a look, mostly for which way it's heading. 6 months ago, its momentum grade was a B. 3 months ago, it slipped to a C+. Now it's an A-. Risk moved the same direction, C- to C to B-, which is really just a one-year chart from earlier, told in letters instead of a line. Where it scores hardest is liquidity, and that's a straight A+. The fund holds $101 billion. The median ETF holds $268 million. It trades over 20 million shares a day, and the gap between what you'd pay and what you'd get back selling it right now works out to be about a penny a share. So getting in and out of this thing costs you almost nothing. It's also a calmer ride than most. Volatility runs about 22% below the typical ETF. The worst mark on the card is a D+. For how far the fund drifted from the index, it's supposed to be copying this past year. Over 3 and 5 years, it's back in line, but that's a blemish. And the analysts covering it? 10 of them weighed in over the last month. 2 said strong buy, 5 said buy, 2 said hold, and 1 said sell. Even on the most popular dividend fund in the country, somebody's out. It has raised what it pays out for 14 years running, which is very nearly the fund's whole life. It launched back in 2011. And this isn't the fund that catches every rally. The 10-year chart shows that. But across those 104 companies, SCHD blends out to a 3.19% dividend yield. Dividend growth averaging 10.24% a year over the last decade, and share price appreciation of 8.43%. That dividend growth is the reason you'd buy this fund. A 3.19% yield is fine, nothing special. Plenty of funds beat it. But a payout climbing 10% a year is a raise you never had to ask for, and it turns up whether the share price cooperates or not. Those 3 numbers are what every projection in the rest of this video runs on. So that's the fund. None of it decides how this portfolio ends, though. That comes down to one choice. What do you do with the dividend when it lands in your account? And in the end, I'll show you how that decision makes it possible to reach a $2.6 million portfolio, paying over $10,000 a month in dividend income. But first, let's see what you can do with dividends. There are two things you can do. 1. Take the cash. 2. Reinvest it and buy more shares of SCHD. Let's take 5 years and watch what each answer does. Josh and Adam both put $10,000 into SCHD on the same day. At $32.90 a share, that's 304 shares each. Same fund, same yield, same 5 years. The only difference between them is what happens when the fund pays out. Adam takes his dividends as cash, so this account rides on the share price alone. Year 1, it's projected at $10,843. By year 2, it's around $11,757, and by year 5, it lands at $14,988. He's also collected $1,957 in cash along the way, sitting in his account, spent or not spent. Added together, and Adam's at $16,945. Now Josh, instead of taking the cash, he's got a DRIP switched on, a dividend reinvestment plan. Every payout automatically buys him more shares of the fund, and those new shares start paying their own dividends the next quarter. Here's what the projections show. Year 1, Josh is at $11,162, which is exactly where Adam is. Same money, same day, no difference at all. Year 2 is where they split, barely. $12,465 against $12,428. That's a $37 gap after 2 years. Basically nothing. But watch what happens to that gap. $37, then $120, then $259. And by year 5, Josh is at $17,411 against Adam's $16,945. A $466 difference. Now, $466 on $10,000 is not going to change anybody's life, and I'm not selling this as though it does. Over 5 years, this is slow. Here's the big thing that actually happened, though. It's got nothing to do with dollars. Adam still owns 304 shares. Same 304 he bought on day 1. Josh owns 358. Every payout bought him a few more. Those started paying too, and 5 years in, he's holding 50 plus shares he never put a dollar toward. That's the loop. His money made money, which bought more shares, which made more money. Right, that was $10,000. Josh isn't working with $10,000, he's working toward $10,000 a month, which is a different animal entirely. And there are exactly 2 ways in. One deposit made once, left alone until he retires, or a small daily investment for anybody who hasn't got a lump sum. Let's start with the one-time investment. For this, Josh's number is $75,000, which is a lot of money, and I'm not going to pretend otherwise. But hold it next to the $3,761,755 we worked out at the start. It's about 2% of it. At that median wage, $75,000 is roughly 2,385 hours of work. Call it 14 months, against the 119,610 hours it'd take to save the whole pile yourself. And before anybody says nobody has $75,000 lying around, some people do, and it's usually not spare cash. It's a 401k from a job somebody left in their 30s. It's equity from a house that sold. It's money a parent left behind. Or it's 15 years of saving that's currently sitting in a bank account earning almost nothing. Josh puts it in once, then he never adds another dollar. Here's what the projections show. By year 1, the account is valued at $83,715, and SCHD pays him $2,393, about $199 a month. By year 10, the balance is projected at $230,715, which is a dividend of $7,710, somewhere around $643 a month. By year 20, the account reaches $754,077. The dividend that year is projected at $29,955. That's $2,496 a month. That's rent in most of the country. Then year 30, the balance is projected to reach $2,648,764, paying around $124,918, or $10,410 a month. Now hang on, because you might have caught something. We said you needed $3,761,755 to collect $10,000 a month. Josh gets there on $2.6 million. That's the dividend's growth doing its job. When a fund raises its payout faster than its share price climbs, 10.24% against 8.43%, the income keeps gaining ground on the account. So 30 years in, the same fund is handing back 4.72% of what it's worth instead of 3.19%. So that's the one-time version, $10,410 a month out of a single deposit he made once and then forgot about. But most people haven't got $75,000 sitting anywhere. What they've got is a paycheck. So here's the same finish line with a more realistic approach. No pile sitting anywhere, nothing inherited, nothing left over from a house that's sold. Just $25 a day out of the paycheck. That's $9,125 a year. And at the median wage we worked out earlier, it's about 290 hours of work. Call it an hour out of every working day, handed to the fund instead of to Josh. Here's what the projections show. Year 1, he's put in $9,125. By year 10, the account is projected at $160,058, with a dividend of $5,044, somewhere around $420 a month. Year 20 is where it stops behaving like a savings account. The balance reaches $688,702. The dividend that year is projected at $26,996, or $2,250 a month. And by year 30, the portfolio is projected to reach $2,591,547, and it would pay around $121,790 in annual dividend income, which comes to about $10,149 a month. $25 a day got Josh to $2.59 million. If you want to invest in a growth fund, there is one fund that's projected to turn $7 a day into a $2 million portfolio. That video's on screen right now.